The $750 XRP Prophecy, dissecting Jake Claver's wild financial domino theory. You know what kept me up until 3 a.m. last night? I was deep in a rabbit hole analyzing what might be the most audacious cryptocurrency prediction I've ever encountered. A prominent analyst named Jake Claver just dropped a bombshell theory claiming XRP could hit $750 by December 2025. And folks, after spending days dissecting institutional Federal Reserve reports, Treasury Department assessments, and cross-border settlement optimization data, I'm genuinely stunned by the mathematical complexity behind this seemingly impossible prediction. Here's what blew my mind. We're not talking about some random crypto influencer throwing darts at a price chart. According to multiple Treasury Borrowing Advisory Committee sources and Kansas City Fed bulletins I've been analyzing, we're potentially looking at a convergence of macroeconomic factors that could fundamentally reshape how $10 trillion in daily global payments flow through our financial system. Let me paint you the picture that kept me glued to my screen. It's Tuesday morning, you're scrolling through crypto Twitter with your coffee, and suddenly everyone's buzzing about this domino theory that sounds like something out of a financial thriller. That was me last week when Jake's predictions started trending worldwide. But here's where it gets absolutely fascinating. The mathematical implications are mind-blowing. With XRP's current circulating supply of 58.55 billion tokens trading around $3.23, we're talking about a market capitalization explosion from $210 billion to approximately $43.9 trillion. Think about this for a second. That's roughly 20 to 25 times Bitcoin's current $2.5 trillion market cap and would exceed the entire global cryptocurrency market capitalization of $4.12 trillion by more than tenfold. Now pay attention because Jake's domino theory is where this gets really wild. Picture the first domino, a massive oil shock that forces Japan's bank into emergency monetary action. Here's what most people don't realize. Japanese financial institutions currently maintain what industry insiders call carry trades exceeding $10 trillion in notional exposure. When oil prices historically surge beyond 50% in short time frames, like during the 1973 Arab oil embargo when crude prices leapt over 200% in less than 6 months, or 2022's Russian supply disruptions, central banks face immediate inflationary pressures requiring rapid interest rate adjustments from near zero to at least 1%. But wait until you hear the regulatory bombshell that changes everything. According to official court documents I've been analyzing, something remarkable happened on August 7, 2025. The SEC's long-running case against Ripple Labs officially concluded, with both parties informing the Second Circuit Court of Appeals that they were voluntarily dismissing their respective appeals. This isn't speculation anymore. It's documented legal resolution that removes the primary barrier to institutional adoption. This completely transforms the landscape when you consider these numbers. Federal Reserve data confirms that Ripple's on-demand liquidity platform now spans over 300 financial institutions across 70-plus countries, processing $15 billion annually. Compare this to traditional SWIFT systems, handling approximately $150 trillion yearly, but requiring 1 to 5 days for settlement at costs up to 6%, while XRP transactions finalize in 3 to 5 seconds at fees below $0.0002. Here's where Jake's theory gets absolutely wild, and honestly, this is what made me lose sleep. Tether, controlling roughly $157 billion in market capitalization according to their Q2 2025 attestation report, faces ongoing federal investigations in Manhattan for potential sanctions violations and money laundering. Their attestation reports reveal that only 84% of reserves are classified as cash or short-term treasuries, with roughly 10% in secured loans and corporate bonds, including a sizable tranche extended to the now-collapsed Celsius network. Think about the implications if Tether implodes. We're looking at a liquidity vacuum requiring immediate alternatives for the $100 billion in daily trading volume it currently facilitates. Academic research from May 2025 found that Tether's Treasury bill holdings, approximately $98.5 billion, account for about 1.6% of the total Treasury bill market, making Tether one of the largest non-sovereign buyers. Econometric modeling shows that marginal changes in Tether's market share directly influence short-term yields by 14 to 16 basis points. Let me tell you something that surprised even seasoned institutional strategists. The XRP ledger processes approximately 2.14 million daily transactions with sub-5-second finality, making it roughly 57,000 times more energy efficient than Bitcoin's proof-of-work model. We're talking about 0.0079 kilowatt-hours per transaction versus Bitcoin's staggering 1,200 kilowatt-hours. That's the energy equivalent of powering just 50 U.S. households annually versus Bitcoin's 13 million. Coming up, I'm going to reveal the massive corporate treasury shift that custody providers are calling unprecedented. But first, you need to understand the mechanism behind what's happening with tokenized assets. Real-world asset tokenization on XRPL reached $157.4 million by July 2025, representing 100% growth driven by partnerships like Mercado Bitcoin's $200 million initiative. Here's what made my jaw drop during my research. Nature's Miracle Holding Company announced a $20 million XRP allocation on August 15, 2025, becoming among the first non-financial public companies to hold XRP as a strategic reserve asset. But that's just the beginning. Quantum Biopharma, Flora Growth Corp., and Worksport Limited each reported XRP holdings in SEC filings, citing 15% profit on their digital asset allocations. Galaxy Digital held $34 million in XRP, while the ProShares Ultra XRP ETF launched in July 2025 attracted $1.2 billion in assets under management.
You guys, I have a special trick for you, which nobody seems to be using, and I cannot wrap my head around why. Because if you sign up through my link down in the description onto the BuyDefi exchange, you get a 10% deposit bonus. And now stay with me here. Now here comes the important part. If you have any trading capital on any other exchange and you move it to your newly created BuyDefi account, you get on top of your capital, you moved another 10% extra trading capital. As an example, if you move or deposit a 10K to your account, you get 1K for free. And here is why this is possible. BuyDefi makes money on trading fees. The more capital you have, the more you trade. The more you trade, the more they earn. So they're literally investing in your trading activity by giving you extra capital up front. And unlike other platforms where bonuses are in the 1 to 3% range, BuyDefi's bonus is a full 10%. I am not kidding. I really don't understand why nobody is doing this. To me, it really seems like people sometimes are too lazy or just don't like free money. I kindly ask you to pause this video and take your time to make an account. You can thank me later in the description of this video.
Now here's where Jake's mega theory becomes mathematically fascinating. The Genius Act, passed in mid-2025, requires stablecoin issuers to maintain 100% backing with high-quality liquid assets, primarily U.S. Treasuries. Treasury Department sources confirm that stablecoin market capitalization could expand from $250 billion to potentially $2 to $4 trillion by 2035, creating massive Treasury demand that could fundamentally reshape government debt markets. I'm not exaggerating when I say this might blow your mind. Under current asset mixes, every additional dollar in stablecoins would increase aggregate treasury demand by 50 cents, while simultaneously reducing banks' treasury holdings by 20 cents and reducing loans outstanding by 50 cents. A hypothetical $650 billion expansion of the stablecoin market could shift $325 billion of bank loans out of the economy, even as treasury demand rose by $195 billion. What you're about to see will shock you regarding the technical infrastructure development that's happening right now. The recent activation of XLS65 Single Asset Vault and XLS66 Native Lending Protocol amendments has enabled revolutionary on-chain pooled liquidity and uncollateralized lending. First quarter metrics show over 120 vaults created, holding 50+ million XRP and 200 million stablecoin tokens, with over 500 uncollateralized loans totaling 10 million XRP at fixed rates between 3 and 5% annualized. Here's the twist that absolutely stunned me during my deep dive analysis. The XRPL ledger's deflationary tokenomics through transaction fee burns destroy approximately 0.00001 XRP per transaction rather than paying fees to validators. At current throughput levels of 1,500 transactions per second, this creates an annual burn rate of roughly 78 million XRP, or 0.078% of total supply. In Q2 2025, network-wide fees burned amounted to approximately 112,000 XRP, equivalent to $63,000, marking the first quarter where on-chain fee burns consistently exceeded new issuance. Lightbulb moment. This is where institutional adoption becomes crucial. Every XRPL transaction contributes to this deflationary pressure, while supporting real-world utility. In Q1 2025, cross-industry pilots processed $4.2 billion in retail remittances using ODL corridors in Southeast Asia, Latin America, and Africa, equating to over 5% of total remittance flows in those corridors, with cost savings averaging 65% compared to legacy remittance services. Let me reveal something that'll make institutional risk managers lean forward. The Depository Trust and Clearing Corporation, which processes over $4 quadrillion annually, filed patents in 2025 specifically referencing digital liquidity tokens, including XRP and Stellar, as compatible settlement rails. Remember, even fractional adoption by the DTCC represents monumental volume increases that could dwarf current cryptocurrency market activity. This is where Jake's analysis becomes particularly compelling from a central banking perspective. The Bank for International Settlements 2024 report identifies XRPL as meeting 87% of central bank requirements for CBDC infrastructure. This isn't wishful thinking. It's documented institutional assessment from the world's central banking authority. A Southeast Asian central bank tested a vault-backed stablecoin issuance, leveraging vault shares to represent fractional central bank reserves with remarkable success. And here's where it gets really interesting regarding systematic risk assessment. Statistical modeling by crypto quant firms suggests that a 10% global equity drawdown, combined with a 50% crude price increase, could trigger a 25% sell-off in Bitcoin and a 30% collapse in altcoins due to margin-driven liquidations. In such scenarios, XRP's instant settlement finality becomes critically valuable when traditional correspondent banking corridors face operational backlogs. But let's talk reality check for a moment, because I always give you the unvarnished truth. The mathematical requirements for $750 XRP, a $43.9 trillion market capitalization, would position it above most national economies and would require absorption of liquidity from traditional asset classes, including government bonds and corporate equities. For perspective, global M3 money supply stands around $25 trillion, and total cryptocurrency market capitalization hovers near $4.12 trillion. Current prudential regulations under Basel III compliance standards are evolving to accommodate distributed ledger settlements. A BIS white paper proposed allocating favorable risk weights to blockchain-settled exposures, potentially granting zero or minimal capital charges for XRP-backed settlement exposures. But even if XRP captured 1% market penetration as a bridge currency for the $7.5 trillion daily foreign exchange market, the resulting transaction volume faces massive infrastructure scaling challenges. Now, here's my personal take after consuming literally hundreds of pages of regulatory filings and institutional research. Jake's individual catalysts, oil shocks, yen carry unwinds, stablecoin regulation, tether investigations, ETF approvals, each carry legitimate probability when analyzed individually. However, their sequential alignment within his compressed 5-month time frame represents what statisticians call an extreme outlier scenario, with joint probability becoming vanishingly small when multiplied together. The environmental angle particularly caught my attention during my research marathons. Corporate treasury demand is emerging faster than most analysts anticipated. UBS and Standard Chartered disclosed in Q2 2025 that they're developing liquidity marketplaces on XRPL, where banks can bid for intraday liquidity in tokenized form, effectively monetizing their balance sheet capacity in near real time.
From a counterparty risk mitigation perspective, something really interesting is happening. Unlike collateralized DeFi protocols requiring 150% plus over-collateralization, XLS66 uncollateralized lending model delegates underwriting to regulated loan brokers while maintaining transparent on-chain enforcement. Default rates have remained below 2% in testing, thanks to conservative underwriting and automated risk management triggers. But here's where institutional inertia becomes the elephant in the room that Jake's theory might underestimate. Converting existing infrastructure to on-chain rails requires robust SLA guarantees, error handling mechanisms, and fallback procedures to legacy systems. Banks currently monetizing slow settlement rails generate billions annually from correspondent banking operations. There's massive institutional resistance to cannibalization without new revenue streams. The convergence of regulatory clarity through the Genius Act, legal resolution of the SEC case, and growing corporate demand suggests XRP's path towards serving as a global bridge currency is becoming increasingly plausible. However, achieving the total global utility and liquidity migration Jake envisions requires overcoming entrenched revenue models where major banks like JP Chase report multi-billion-dollar profits annually from traditional correspondent banking fees. So what's my bottom line on Jake's $750 prediction after this exhaustive analysis? The technical capabilities absolutely exist. The regulatory framework is rapidly emerging, and institutional validation is accelerating faster than I expected. The activation of XLS65 and XLS66 creates genuine DeFi primitives that could revolutionize on-chain finance. The legal victory removes massive regulatory overhang. Corporate adoption is accelerating with measurable treasury allocations. But the compressed timeline requiring financial system transformation that historically unfolds over decades, not months, makes this an extreme probability scenario. More realistic institutional projections suggest XRP trading between $5 and $15 through 2025-2026, driven by incremental ODL growth, custody expansion, and potential ETF inflows. Bull case scenarios incorporating cascading institutional adoption could target $25 to $50 by mid-2026, but even these extend beyond Jake's deadline. Here's my final analysis after this deep dive research marathon. XRP absolutely possesses the technological foundation, growing institutional validation, and legal clarity to achieve substantial price appreciation. The confluence of tokenized asset growth reaching $157.4 million, stablecoin integration, corporate treasury adoption, and potential ETF launches provides legitimate catalysts for significant upside. But Jake's $750 target represents financial system transformation requiring exceptional circumstances aligning within an improbable timeframe. Smart institutional capital focuses on probability-weighted scenarios rather than extreme outliers, regardless of how compelling the underlying technology might be. What I can tell you with confidence is this: the next 12 to 18 months will be absolutely critical for XRP's trajectory. The combination of legal clarity, technological advancement through DeFi amendments, and accelerating institutional adoption creates a foundation for sustained growth, just maybe not quite as explosive as Jake's timeline suggests. That analysis just happened. I've given you the complete breakdown of the $750 theory using hardcore institutional data, the mathematical foundations supporting various scenarios, and realistic probability assessments. XRP remains a compelling long-term opportunity, but managing expectations around extreme price targets protects against disappointment while maintaining focus on genuine fundamental developments driving this digital asset transformation. Smash that like button if this data-heavy analysis helped you understand the complex institutional dynamics behind cryptocurrency valuation models. Drop a comment sharing whether you think Jake's domino theory can actually unfold. The research suggests both revolutionary potential and significant implementation challenges.